Today's market call is brought to you by MoneyLion, the first digital ecosystem for consumer finance, empowering everyone to make their best financial decisions. A glorious morning here on the East Coast at 11 a.m. East Coast time. That's Dan Nathan. I'm Guy Adami, soon to be joined by the great Carter Worth. The final Monday in September, the penultimate day in the month of September, which means maybe it's quarter end, month end for some people tomorrow. Who knows if it was Friday? I don't know. I lose track of things, but what I don't lose track of is the following. Baseball playoffs start this week. The Mets will not be in the playoffs this year. The Mets, who spent north of $300 million on payroll, who had the best record in baseball for the first half of the season, have been summarily left off the playoff invitation list, which I can't begin to tell you, Dan, how happy that makes me.
I know it does. And you and I were talking earlier this morning. You said it's kind of, I said, how was your weekend? You basically, you didn't say this, but like, this is where everything lines up in your head. It's like Yankees win. They don't win the AL East. Fine. You know what I mean? Fine. They're going to beat the Sox.
Well, no. That's all it is. That's not.
Okay, whatever. But the Mets blow it, and they will not be in the postseason, which is an amazing thing. Then the other thing, Bill just informed me that your Giants won. You're 1-3 Giants. Maybe your boy Dart is going to turn things around. Hey, listen, all right, Bill, maybe you can help us. I promise we're going to get to stocks. What was the Giants record when they won the Super Bowl? Was it 08, the last Super Bowl in 09? Or was
I don't think they started 1-3.
They didn't start. Jacob will be Johnny on the spot with this.
I think they finished the season 10-6.
What were they after 5 games? That's what I want to know.
I bet you it was 2-3. A total guess. I do not know this, but Jacob can effort it back in HQ.
I don't know. I think they started worse. Okay, Guy, I see a lot of green on my screen. Why do you? Because it's open.
You know, I'll be honest with you. I don't know. I think, again, part of it has to do with, I heard President Trump make a comment about basically, I guess, the tax one pays, capital gains tax on selling a home. They're looking to potentially roll back. I don't know if that has anything to do with it. You know, the enthusiasm for things are still out there. Nothing happened over the weekend. I do think it's some sort of month-end, quarter-end type of situation. I don't know. I mean, you got some of these semis partying. Again, it's one of those days that I really can't put my finger on.
Let's pull up Nvidia for a second here, up 3% on the day. I spent a lot of time reading about Nvidia over the weekend, and I actually I copied you on a couple of emails. I went to the Chat GPT. There was a great article in the Information just talking about the circular nature of, Nvidia. And, it's so extensive when you think about what's going on. They basically have all these hyperscalers that obviously are buying their chips, right? They're basically investing in the private ecosystem. We're not even going to put OpenAI in the private ecosystem, and then they are basically, OpenAI is building building data centers to compete with their biggest, customers and the like here. And that's some of the hyperscalers. And they're investing in, Nebius and Lambda and CoreWeave, which are these neo clouds, right? And so they're taking investments, and then those guys are buying their chips, and then they're basically renting out their compute back to that. It just seems all crazy. But then you come in on a day like today, and people are spending a lot of time thinking about this, and you look at the stock up 3%. I look at that guy, and I look at that consolidation. Let's go back five years here. I mean, the story of the Nvidia rise is big gaps, consolidation, big runs, right? This consolidation over the last, call it before April, was basically a long digestion period. It didn't look particularly that healthy. It was underperforming the S&P 500 for a while, but then you get this big move, and now you get a consolidation. And your guess is as good as mine. And you and I were talking about this on the Risk Reversal podcast because Jensen Huang was on the B2G podcast with Brad Gerstner last week. And they were asking him, why do you think Wall Street consensus estimates are like literally for mid-teens growth for the next couple of years after 2026 or something like that? And he's basically, I don't mind having low expectations. So, this thing, I mean, you tell me, is this the tail wagging the dog, or are we about to have a really epic sort of meltdown at some point in 2026? And I'll throw Oracle in there and all that sort of stuff. And the way these guys are raising cash now through debt and the like, it just seems like there was no shortage of discussions of this now that are really skeptical about this situation.
Doug Cass was probably one of the first people to write about this vendor financing. I know we talked about it. So first thing that came into my mind when, I think it was last week, but I lose track of time, that again, Nvidia making investments in companies, they're going to turn around and buy their chips from them. It seems a little fugazi to me, not suggesting that there's anything illegal about it, because there's not. This has probably been going on as long as there have been business models, but it feels sort of like late cycle stuff to me. Now, the market is saying it's different. It's clear. You hear it over and over again. It's different this time. You're missing the boat. And, maybe in fact it will be. I don't think so. I think the only thing different are the names. But, all the things that we're seeing now have been playing out for decades. And as long as I've been in the market, I know as long as you've been in the market, we've seen things like this before, and typically doesn't end particularly well.
Yeah, I guess the only thing I'd say is that, so if OpenAI started this whole thing, OpenAI started, basically buying all of the inventory of Nvidia. This is going back 2.5 years or so. Microsoft, who had a partnership with OpenAI, they were buying all the inventory. Google is making their own chips. OpenAI is making their own chips with Broadcom. Google makes their own chips. AWS is working on their own chips. There seems to be no shortage of competition
Alibaba,
coming. But they're all interrelated. You know what I mean? That's the issue here. So if there is a slowdown, in demand, then Nvidia gets hurt, but then it kind of works its way through this entire ecosystem that not only have they invested in, but they're expecting the demand to come from those investments. And so you have OpenAI and Nvidia. Nvidia is starting their own data centers, and they're doing these leaseback deals with their chips to, from the Neo cloud. It's so confusing. I actually went into ChatGPT and asked to lay it all out last night after reading these articles, and maybe we'll put this in the show notes. It's pretty fascinating because, I sent it to you. I sent it to some of our friends, Danny Porter, Vinny, Jim Chanos, Doug. It's just, this is what's different, Guy. I mean, this is what's different, the interrelation of all these companies, So.
Yeah. Well, and you mentioned a lot of things, but what nobody talks about is the possibility for a slowdown. And again, there's an inevitability to slowdowns, just in terms of the economic cycle, but nobody seems to factor in the fact that if there is a slowdown, Nvidia is not going to be spared from it. And if CapEx spending is not as pristine, or as the sanctity of it is the word we use all the time, something happens, I mean, Nvidia loses to that. And people seem to think this growth is going to continue, not in perpetuity, but for the foreseeable future. And when I say foreseeable future, I mean they're pricing things out 3 to 5 years, and I don't know how you can do that in this environment.
Yeah, no doubt. Listen, this chart looks great. I mean, let's be frank, and it's got an upward sloping, 150-day moving average. That's the Carter moving average there, and it's seen this consolidation. We talked about how this stock is traded, so we'll just kind of leave it at that. And I think a failed breakout, might be something to kind of take another look. Maybe there's potential for a downside move to that breakout level. I think that was in late June or so. But if data is the new oil, Guy. Then oil is the old oil. And we're going to look at oil with our main man, Carter Braxton Worth of Worth Charting. He's going to join us here on a Monday morning. We really appreciate it.
Let's bring him in. I love when we bring. Look at that. Here he comes.
There he is.
Hi, how are you?
There he is.
Waiting, our main man. We're going to get you in and out of here because we know you're busy, man. Just so you guys know. And
that's a new shirt, by the way. That's a new colored shirt on Carter. I haven't seen that one before.
Odd color, right? So I couldn't figure what color. What would you call that blue? Slate blue, something.
Yeah, it's like a grayish blue or something like that.
It.
Let's throw this up here because we haven't looked at it in a while. If you're interested in Worth Charting, go to worthcharting.com because what is it, Guy? What's the tagline here?
It's nothing fancy. It's just charts. I won't use
nothing slick, just charts.
I won't use the vernacular.
We love it. Carter, we wanted you to kind of break down last week. I think when you and I were on together, we talked a little bit about the energy complex. And we're going to get to that in a second. But I want to start with the US dollar because, and I want to get a sense for like how you're thinking about this. And here's the chart. But one of the reasons why I was thinking about the dollar and then obviously kind of drawing the line a little bit to energy. Let's go to this Torsten Slock note. He writes every morning. He's just prolific, in my opinion. This is Torsten from Apollo. So the US dollar has depreciated almost 10% since the beginning of the year. And the Fed's model for the US economy finds that a 10% depreciation result in a 0.3 or 0.5% boost of inflation. Put differently, there is not only the upward pressure on inflation from tariffs and immigration restrictions, but also from the ongoing dollar depreciation. Guy, I'm bringing this up because, Friday we had the PCE, it came in line. Some folks had different views of this, but I also think the dollar in here is kind of an interesting way to think about inflation also.
Yeah, we've talked about this ad nauseum, it seems like, and Carter's going to show where he thinks the dollar's going, but what we've brought up a number of times is a weakening dollar, although helpful on a number of different fronts, not least of which the debt problem that the United States has, is a tax on the consumer, and it's inflationary by definition. Your buying power goes down, and he's pointing this out in real time. So it's great if you're trying to inflate your way out of a problem or basically deflate your currency way out of a problem, but it's really bad for the consumer because, again, each passing day your dollar buys a little bit less. By the way, it's not just over the last however many months that he talked about. I mean, this has been going on for the last 90 years. The dollar's lost 95% of its buying power since 1935, Dan.
Yeah. So Carter, this was our impetus for thinking about this. Just curious what you're seeing in the charts. I know these guys flashed it up a little bit, but again, this is one of the biggest, I guess we call it a risk asset on the planet. And so there's so much stuff that is, traded on the back end of like how basically this thing is traded.
Yeah, the dollar's the almighty greenback, as they call it, and it is the single biggest security, bar none. And the value of all, put it this way, the value of all stocks traded in any given day is X. The value of all bonds traded is double that. And the value of all currencies is double that. It's the big thing, right? And it's the buck stops here, to use that expression. But let's look at the chart of the dollar. To my eye, this is at risk here. So essentially the dollar has been ascending since the lows of the financial crisis in 2009. We know in 1985, they had to get together and devalue the dollar. It was called the Plaza Accord. And indeed, that worked. And then since 2009, with a lot of variability, the dollar essentially has been moving up. And of course, its spike high happens there really sort of, you see the COVID low along the trend line, then it spikes in 21, 22, and here we are at risk, I think, of basically breaking trend. And so my bet would be lower dollar.
Yep, I'm with you on that. We've said it for a while. Your charts speak volumes. This goes back 50 years now, so you can see what we're up against. And this uptrend line's been intact for the last 23 years-ish, 21 years. But let me ask you this question. What, if anything, does it mean in terms of the relationship it has with crude oil? Because unlike gold, crude's been its own sort of animal, sideways to lower now for quite some time. And I know you brought some charts, so walk us through.
Yeah, it's funny because, of course, if it were a perfect inverse relationship, then whenever the dollar was weak, all commodities would rally, and that doesn't happen right now. The grains are all at multi-year lows. It's not having an impact, and gold is surging, has been surging, while oil is not exactly, off to the races where a weak dollar would suggest it would help that. But I brought this long-term chart just to put in context, of course, something that was unfathomable for a brief period there. Not only was crude negative, it was negative $30, $40 a barrel. It was only for an instant or two on the day in question, but it did happen. And so this is what a pair of twos is. There's nothing here that, and even if one just whited out with your eye, the below zero part, what is this? It's been it spikes with the invasion of Ukraine, and it's been trailing off ever since. And it's just sitting here at an equilibrium price that is probably maybe where oil belongs, so to speak. Now, adjusted for inflation, oil is the same level it was in 1984. And so oil as an input cost, it continues to be lower and lower on a relative basis, adjusted for inflation, than at any time in the past, 30, 40 years.
Yeah, and one of the reasons we wanted to kind of draw this line is because the breakdown in that kind of inverse relationship that some folks have become accustomed to. And when you think about how we started this conversation with the dollar weakness, what it's doing to inflation pressure, it is interesting that on the flip side of this, you basically have, to your point about an input cost, something that is not participating, at least in that inflation discussion here. So again, pair of twos, we want to get to the large integrateds because you and I were talking about this last week. I think you mentioned that you like the drillers, but you're not as in tune or not as excited about the large integrateds.
Yeah, right. So just to put this all in context, of course, there are 11 sectors in the S&P 500, and energy is only 2.9% weight, whereas something like an Apple is 7%, right? And so it's a very small part of the U.S. stock market, and yet a major part of the economy in terms of employment and impact and so forth, and ancillary and related industries. But this XLE, which again measures just 2.9%, about 14, 15 stocks, with Exxon, Chevron, Conoco making up half essentially. It's a pair of twos. We can draw the lines many ways, but the first thing we know is that spike of last week filled the unfilled gap associated with the tariff plunge. And we're sitting here in this sort of no man's land. There's nothing about that is bullish or bearish, in the sense that it's already been bullish. It's rallied from 75 right to 90, almost 95, and now is not really a great time to add, and I would say not a great time to be short. We might have some longer term or draw the lines that way. It's just there's nothing here. It's not a negative conclusion. That's just the facts, at least by my work. There's nothing to be done. The oil services not depicted here were bombed out and have curled up. So those are bearish to bullish reversals.
Yeah, and I'll say this, in terms of the XLE, you're right. Some of the other names that we've talked about, for example, Valero, some of these refiners, Marathon Petroleum, they've all done extraordinarily well. If you want to pull up a Valero chart real quick, Jacob, you could see the performance that this stock has had. We're approaching levels we haven't seen in a few years. And if you go longer term, we'll see what I'm looking at. So there have been some energy names that have been working. It just hasn't been in the names that's seemingly talked about every day. So Carter, we have a question from Gary Webb, which I know you can answer. I probably know what your answer is going to be, but I'm sure Gary wants to hear it from your mouth. And it basically comes down to, when would you consider reconsidering your 10-year directional call, which has been lower and it's been right? Here 10-year yields probably about what, 4.15, 4.14 or something as we're sitting here today. Thoughts on that? Yeah,
this is a pair of twos as well. It's not. I think the primary judgment that I was trying to make, 2.5 years ago, is that rates, it was all the rage that rates were going to go a lot higher. I just didn't believe that. And I'm pleased with the fact that never happened. So the opposite of not going higher is lower, but they haven't really gone lower. They just haven't done what consensus was looking for. I mean, lower yields is really, you get into the threes. I mean, we were at almost 380 there at the tariff plunge and so forth. But I guess the answer to the question is just a change in the chart, right? The facts change, and then you have to change your opinion. Nothing's changed. The truth is, it's been one of the reasons, I suppose, that equities have been so resilient, is that this is truly the definition of Goldilocks. The cost of capital is very low.
Okay, so let me do this real quick, Dan. I'm sorry, but pull up a TLT chart, and if you can go sort of longer term, here's my question in a different form. TLT, as you can tell, there's been no meaningful bounce in TLT over the last,
it's just been basing, but not turning. Yep.
Right. My question to you is exactly that. At what level do you start to see sort of this bearish to bullish reversal? Because right now we're sort of, I think we both agree we're sort of flatlining here. It goes one of two ways. I think it breaks down, yields go higher. You think it's a pair of twos. There are other people that would seemingly think we're forming a bottom. But I guess my question is, where do we close above where things start to get interesting in terms of that bearish to bullish reversal, if you can sort of eyeball that?
Yeah, I mean, to think that in this process, it's reached as high as 100, and as the expression goes in the casino, it crapped out, right? All chips are removed, start over. And so it keeps neither going lower nor basing in a way that allows it to fully turn.
Mm-hmm.
And so all that one can say is that this is just a big base, and obviously it can't just stay here forever in principle. And then yields are just permanently in this nirvana of 4%. That's not likely. Something comes along that informs things and changes the path or trajectory that we're on. And a lot of people say it's real inflation that's going to get us back into 5-6% on the 10-year and then some, or people abandoning foreign buyers, abandoning treasuries, or it's a recession and the yields really do go lower. But I mean, obviously something has to give. The real thing that makes it hard is when you're in a trade that neither works or doesn't work, because then you hang in and you hang in and you hang in. Whereas if it doesn't work, you get out at some point. I mean, assuming you have some discipline, or if it works, you ride it and then take some profits. This is not allowing for anything. And so there it is. And there's nothing more to say.
Yeah, a guy and I are on different sides of this, but it'll be interesting to see it. Just keep watching that CME Fed Watch tool and get a sense for what the potential outcomes for a OC and NOV, right? Or do we not have a NOV meeting?
No NOV meeting.
Yeah. All right. Two things, Carter. We appreciate you being here. I got to read this from Alex Rifkin. Is that Carter or Clark Kent? That's interesting, because Clark Kent in almost every version, I think in every version of Superman guy, was a great looking man. He was one of those guys, you know what I mean, meant to just kind of.
Clark Kent. Well, yes, I have. I get to 60. I find it, my eyes are not as good, so I have to wear readers.
There's no way you were 60 years. I don't buy it. I've known you for 15 years, 16. I don't buy it. You've
coming up in June.
All right, last one here. This is from Clubber Lang guy. Who's Clubber Lang? What's Clubber Lang?
If you recall, that was a Rocky opponent played by Mr. T.
In Rocky 3, which I think you will probably say jumped the shark a little bit. Rocky 2 is the equivalent of Godfather 2 for that series. Like, can we be honest about that? And maybe Rocky 3 is equivalent to the Godfather 3.
Let's not put Rocky in Godfather
I'm just
echelon.
talking about if we're going down parallel paths.
Hold on, I got to say this. Did you know? I just learned this, that he wrote. We know he wrote that, right?
Yes.
So that's alone. And then he took it around, and people said it's really good. Yep. And they said 35 grand. He was like, no, that seems a little low. And then I think I don't know where it. And then they said, fine, he got up to a number, but they said, but he said, yeah, but I'm acting in it. And they were like, what?
Mm-hmm.
No, you're not. We were just buying the film. You can't act in it. And of course, he held out. And then imagine if he'd sold the damn thing, and then that was that.
He had not a pot to piss in, as they say at the time.
And he stuck to his. I mean, awesome.
I don't think people, if you were a kid of the 80s, which I was, and you watched, let's just say the first Rocky, and a lot of folks my age, the first Rocky they ever saw was Rocky 3, which Hulk Hogan and Mr. T, it just felt like it was really like.
Hold on, I saw the first one in a movie theater.
I'm sure, but then Eye of the Tiger,
punching the meat, and Yo Adrian. I mean,
yeah. This was a popcorn movie, and part of it is that he jumped the shark in the movie. You know what I mean? Like that sort of. Okay, moving on from that. Good stuff. Carter, last thing. This is from. Hold on one second. I gotta find it. I just saw it.
Butkus.
Oh no, Clubber Lang acting. Thoughts on UPS? Ripe on the charts, or is it a value trap? Value trap. This is one of the most.
It's so bombed out. It's back. Look at the 20-year chart. You can't believe it. I mean, obviously, this is a terrible chart. There's nothing to talk about here. But look at this. It's to its COVID low. I mean, what it makes you wonder, like, what are they doing over there? Like, they have a plan? Like, how could you have?
But Carter, do you see? Here we are to that COVID low.
Mm-hmm.
There's very few mega cap stocks that I think probably trade this way. is this the potential for a bounce level?
Sure. I mean, I mean, obviously the thing that to talk about really is the fact that it did so well during COVID, right? I mean, that's true, right? They're just packages going everywhere, nobody moving. So they're nirvana for them, all the shipping going on, or no one's leaving their home. But to be back now at that level, 6 years later, plus or minus 5. I mean, it just gets down to this. Forget the chart, forget anything. Is it possible that UPS as an enterprise, as a business, is worth the same it was at the COVID low? It's got to be worth more. I mean, and I haven't looked at its financials and so forth, or looked at what Wall Street consensus is, but just my hunch is to play it for a bounce. So bad it's good. Use the low of COVID as your stop point, breaks it by a dollar or two, walk away. But I mean, it seems incredible.
Yeah. It's a lot of this is UPS specific stuff. We've talked about it. A lot of it is obviously macroeconomic stuff going on and other forces at work, but there's no denying just how poorly. I mean, there's no way else to say it.
Dropping gap, downtrend. Yeah. Now, you do get these surprise things that happen out of this kind of thing. All of a sudden, news from earnings, something it's indicated 97, 98. That kind of thing does happen. I would do this through an option or some far out of the money kind of thing and play a lotto ticket.
Before I wanted to let you go, but you're still here. Nike is a name. So I remember last quarter, Nike reported the quarter didn't seem particularly good. I think the stock was trading around 64 or thereabouts ish, and it proceeded to make a huge move over the next couple of days. I think it was trading in the mid to 70s. We maybe got up to, I don't know, maybe $80, and we've come off since. So, Nike's round trip that entire thing. And we have a question from Gregory C. Does Nike tell you anything here? I look at Nike, full disclosure, and I see a series of lower lows and lower highs. What do you see, Carter? You got to go longer term to see it.
Yeah, my hunch is to play for a bounce here, play for a second gap.
Fair enough, Dan.
All right, Carter Braxton Worth, nothing slick, just charts, worthcharting.com. We thank you for being here, my man. See you later. Thanks. Hey, let's go back to UPS for a second, because Carter said something interesting, Guy, about he hasn't looked at the financials. But, in 2022, this company had peak earnings. Let's go back. Where was the stock trading in 22? That's basically the all-time highs. Was that 255 or something like that? In 2022, Guy, they basically had $13 in earnings. This year, they're expected to have half that, $6.50 in earnings, except for this. Their revenues, which were $100 billion then, are only going to be 87.5, which to me, if you think about that degradation in earnings being cut in half, but the sales are only down 12.5% or something like that, obviously what's going on there. So there's probably some execution issues, there's probably some competitive issues that all those things. But to me, there's an opportunity there. I don't know. Are there activists involved? But this is one of those companies also, Guy, 3% of their sales come from outside the U.S. I could see if we live in the state capitalism age, $71 billion enterprise value or market cap. I mean, what would happen if the U.S. government, and I'm not advocating for this strategy. I just don't think that the U.S. government as a activist investor is a great idea for our form of capitalism. But man, if the government comes to you and you're a U.S. company like this and they say, we want to take a stake, maybe they're just being opportunistic. They know it's kind of like Buffett taking a stake. You know what I mean? You get the stock up 10% and maybe you get other investors to start to chase, and maybe it puts more pressure on the management to make, by the way, though, when activists usually take stakes or private equity or something, what do? They cut jobs. So that seems to be at odds. And let's make no mistake about it. Intel is going to have to cut jobs. So those two things are at odds with each other.
Well, let's put it this way. In today's world, nothing is out of the realm of possibility. And, if they have not looked at a company like UPS yet, my sense is somebody will be looking at it. And I certainly don't think if you've been short this, and there are very few people that are listening to this have been, but this is not the time to be pushing shorts on the downside. This is the time, I think, to say, okay, we just traded down to levels that we last saw 4.5, 5 years ago. Maybe to Carter's point, it's worth a shot on the long side with a very well-defined stop in terms of that prior low. It makes a lot of sense. But what you're talking about, again, in today's world, I think that's just one more variable that's out there, which makes being short names that much more difficult because you just don't know what headline is going to come across the bow.
Yeah. And you know, the question about value trap also, Guy, is kind of interesting because I mean, you just see these gaps to the downside, one after another after another. They're obviously earnings one way or another. And so each time you have investors that maybe long-term investors who just puke it out, or maybe near-term investors who are trying to play the same sort of thing. But after 3 years of this, you know what I mean? It's getting a little tired. There's got to be some value at some point, but it's clearly been a value trap for a couple of years. On the flip side of this, Guy, and I think this is really interesting to take a look at. And there was, as Danny Moses would call, a Friday night dirty. You had Silver Lake taking EA, Electronic Arts, as they say. I know you're a big gamer, so
in the game
that you've been very interested in. Let's pull up Doug's tweet about this, because this is the sort of work that doesn't seem that hard to do. Doug does it on a daily basis at thestreetpro.com, and he puts these kind of pearls out there on the Twitter here. But this is just simple stuff, and it's just another thing that is just suggesting that we are kind of in Sillyville here. So this thing gets taken out at $50 billion on less than $2 billion of EBITDA on a more than 25 times EBITDA multiple. What could possibly go wrong? Look at the borrowing. Are they likely to borrow $20 billion? That's why private equity does this sort of thing, right? They lever it up. Things were flat the last 2 years. Revenue is $78 billion. To me, this is an example of totally unnecessary transaction that will add a lot of debt to a company that doesn't need it. So talk to me, Guy. I mean, like, and let's put this chart up. Let's put a 2 year. Let's put a 5. Put whatever you want up. But this thing was dead as a doornail for a long time.
it was, and you know, Doug's pointing out how that doesn't. Listen, from a business sense, it doesn't make a lot of sense, and just from a mathematical sense, you know, what's really going on here. And you know, this was a name that if you go back and look, forget about the last, you know, couple weeks. I mean, this has been flatlining since 2021. I mean, it was seemingly $150 stock in perpetuity, you know, going up and down a little bit along the way. So there's this, I think the more important point here is not about EA specifically, but it's about some of the excess and largesse and, you know, euphoria around the investing cycle right now. And this is one of those things that you could potentially come back in 3 to 6 months and say, you know, there was that electronics art deal or any number of things that sort of was within however many days of a top.
Yeah, it's just interesting, though, that this deal comes when the stock was very near an all-time high. You know what I mean? Like, it's just odd to me that if you're going to take a company like this that is not that interesting, at least on its existing fundamentals, you know what I mean? Like, and do this sort of deal. Why wouldn't you have done it like earlier this year? It's not like some genius, you know, like analyst just pitched some partner, you know what I mean? Like at the private equity firm and said, here, I have a great idea. So for whatever that's worth, here's one guy, and I love this because you know how people talk all the time about the millennials? They've never seen, you know, a recession. They've never seen a proper bear market, but our friend Millennial Market,
That's a good name.
all the time. It is a good name. Costco about to trigger a massive Head and Shoulders question mark.
Yeah.
So
I think what they're looking at, and I first of all, thanks for tuning in. So my instincts suggest the first shoulder is probably somewhere in December of 2024. The head is hard to say, but I guess it would be February of 25, and then the second shoulder maybe in June of this year-ish, right? And now we're seeing this cascading lower. I mean, we're approaching the levels, and you can do this on the chart. I mean, we were down around 890 or so in March of this year before we bounced, so we're getting precariously close to that. So, yeah, it is. You've pointed this out a number of times. You know, Costco is not traded particularly well now for a decent period of time when historically it does. So there is clearly something to watch here, Dan.
Yeah, and you know, let's pull up Walmart for a second too. It just, you know, these are names that in an inflationary environment, and you get this, you know, consumer trade down. Let's go to 1 year for a second. You would have expected these things to be acting better. Now, we said that about Walmart for the last, you know, sort of month or so. It's held that 150-day has not confirmed the new highs in the S&P 500 despite that recent rally there. So I think these are two stocks to keep an eye on here because, like we've seen some gaps lower, which is not, particularly a common event in these two stocks for whatever that's worth. Guy, I want to highlight something, a conversation I had that I think you were out of town, and I think you would have loved to participate with Peter Bookvar of 1 Point BFG Wealth Advisors. We're working on that name, Guy. I mean, it's a great new name.
Well, no, that's the name. I think.
I know. I mean, but Peter tells me they're gonna shorten it up a little bit. They just wanted to kind of get that whole thing out there as they rebrand a little bit. But he introduced me to a guy which I've known their work, Gavekal. It's Gavekal, and Louis Vincent Gav. He came on the Risk Reversal podcast, I want to say last Wednesday, and it was just an amazing conversation. He's lived in Hong Kong for a long time. He's a French guy. We had a great conversation about China. And look, there's Louis. He's a good-looking man too, Guy. You would have loved to.
He's got it all going on.
Yeah, and he's got a beautiful accent, and he really enjoys being on. And great conversation on China. Great conversation on how they're thinking about this AI. This kind of, if you want to call it, this what do you call it? Well, also, just this competition between the U.S. And China, and he has some very nuanced views about the energy consumption and the infrastructure build and all that sort of stuff, and the potential for them, to kind of innovate on their own, and then also lean on the rest of the world outside of the West that they've gotten to know pretty well through Belt and Road, you know what I mean, and that sort of thing. So interesting conversation. Go to our YouTube page if you're not following it there. Well, if you're listening to this, you're actually watching us on YouTube. Go check out that conversation. It was awesome.
Yeah, listen, I saw this earlier, and I saw some of the notes about it, and it looks like a fascinating conversation for sure. And again, it speaks to, I think when we look at things just through the lens of the United States, we always, and I get it, we want to think we always have the upper hand. We have all the cards, and then many times we do, but many times I think we sort of overestimate things, and sometimes to our detriment. So we'll see.
Yeah, no doubt. We have a question on Tesla, and I want to hit this just as a little bit and Doug's hitting us about financials. We got to hit that too. And I think you and I both saw.
Yeah, they're not trading well.
But let's hit this question first on Tesla, because about, I don't know, a couple of weeks ago, you and I were looking at this chart and we were thinking about just the expectations for Q3 deliveries, and quarter end here, they're going to release them, I want to say maybe Wednesday or Thursday, the first couple of days of the year. Sentiment was really poor. Estimates seemed really low. You had this at the end of this quarter, or the end of the month, you have the consumer rebates on the $7,500 rebate is going away. It's part of this kind of recent, tax bill and the like here. And so you had this big breakout. You could have looked at the downtrend. You could have looked at it back at those prior recent highs, I want to say at the end of May or so. You had this massive move. I think a lot of folks had a similar view as, let's say, we did, of the potential for a breakout for a whole host of reasons that weren't only technical. What do you do with this thing here, Guy? It opened up today, traded almost as high as 450. It's down on the day here. Do you think you see some profit taking? Because this is probably the best case scenario, because I think once you get by a pull forward in Q3, you have this expectation maybe that Q4 sees a dip.
There are people that have tactical views here that think Tesla, people like Guy Adami look at it the wrong way, and you're missing the full picture here. And this is a revolutionary company that's going to be the first, $5 trillion, $10 trillion company. And maybe that comes to fruition. So when I talk about the next $25 or $30, it's somewhat superfluous through that lens. However, they're tactical people as well. And you pointed out a couple weeks ago on Fast Money that, when we sort of got above that 355-ish level, you were looking at a bearish to bullish reversal, and you thought it could rally. That's exactly what happened. Now, we should have theoretically gotten to levels that we saw, I guess, late in December of last year. So December, January of this year, we didn't get there. I'm hard pressed to not think we can do a bit of a back and fill and sort of go back and look what was past resistance becomes support. And it probably comes in somewhere between 355 and 360.
Yeah, I just feel like at this point, you know, I'd pull the ripcord here. If you're in this for a trade and you're playing that sort of momentum, I just think the risk reward here. Okay, maybe, you know, this is not a quarter. They don't release a bunch of metrics. They're basically going to release, you know, the deliveries, and if there's stuff that you can extract, I think the better it is, guy, the worse Q4 is going to be. You know what I'm saying? So like that to me is the risk. And you point to those prior highs in December and you say to yourself, listen, this stock went from 350 to 500. Why couldn't it do it again? I think it was a different environment. I think the expectations of what Elon might be able to do within the administration, I think part of the excitement was like, hey, listen, they're going to be, because of all the help that he gave to Trump during the campaign, that he's going to be able to have his way as far as regulation and, you know, and tax reasons and rebate reasons and all that sort of stuff. And it's clear that doesn't exist anymore. So at this point, it's got to be either doing one of two things: trading off of deliveries, which might be that near-term catalyst, which gets you to the other side. You know, Baird, that Ben Callow, a friend of ours, you know, upgraded the stock last week. I'm going to say it was 440, because all about robotaxi and all about Optimus and all about the future. I don't think it had anything to do with deliveries. So again, I'd pull the ripcord. I mean, is there a chance that it goes from 450 to 500? Sure. I mean, but if you're in it for a trade, I think the risk reward is probably not there anymore. We just mentioned financials. Let's hit them really quickly, guys. So you have a 10-year at 414. You have, this is the first group the large money centers are going to report. You know, as the S&P has been going to report, I think next week, right? At the end of next week.
I got to look and see, but
Let's see.
you're
JP
probably
Morgan
right.
usually kicks it off. Let's just kind of look at that for a second here. It's going to be on April 14th. Okay.
No,
So,
October.
yeah. Well, I don't know why I said April. That was the last time they reported. October 14th. So we got a little time. We got a couple weeks here. What do you know, this thing broke out. This is JP. We saw that XLF has not really broken out. It's been basing here. Thoughts, and then we got to look at the small caps too, because the regional banks, I guess.
There's a lot of enthusiasm around the financials that, you know, we've talked about certain ones. I mean, I think we've done a good job with Citi and some of these names, but I do think a lot of the optimism is somewhat unfounded for a myriad of different reasons, not least of which, I mean, banks are very economically sensitive. And last I looked, they are still very cyclical. And, you know, it appears as though things are slowing down. Now, people point to GDP, but as Peter Bookvar said at the beginning of the year, you're going to get some really lumpy data over the next 6 or 7 months. And that's exactly what's transpired. So I don't think things are nearly as rosy as the banks suggest. People are going to look at the steepening yield curve. But quite frankly, you know, if we were to see, again, the back end go higher, it's not going higher because we have growth, Dan. It's going higher because we have inflation concerns. And I don't think that's going to be particularly rosy for the banks.
Yeah, and I think if you look at it as a leading indicator, you know, you're starting to see riskier and riskier, you know, lending practices, not just to consumers, but also there's been a number of articles about investment grade debt. You know, like Microsoft's debt trades at a better, like trades cheaper, basically, to the U.S. Treasury, to Treasury, you know, bonds, which it just seems like a little interesting, especially on the week that we have the potential for a government shutdown. I think,
which nobody's talking about. It's funny, you know. I mean, it's like we've gotten so desensitized to this stuff.
Well, you know, Peter Bookvar had a great comment in his book report this morning. He's like, I never make investment decisions based on the potential for government shutdowns, because they're always basically fixed within you know, it's just a political cudgel, if you will. You know what I mean? But this seems like the certain administration that maybe they, from political reasons, not policy reasons, for political reasons, they grind this thing out. You know, what they did last week, what they threatened, when I saw the headline that basically they're saying, okay, don't just prepare for, I think it was the Office of Budget Management or whatever, you know, don't only prepare for furloughs to all these different government agencies. They said, get prepared to make, you know, RIFs, reduction in forces, like firing people. Now, they will try to blame it on the Democrats if the Democrats don't vote in line for this. You know, it really is just a push out for a few months, which they already did once. They're going to try to blame it on the Democrats, but I don't know how you can blame, you know, the party that's not in power. But it is what I just thought from a political standpoint, that seemed pretty brilliant. You know what I mean?
Well,
trying to get them to bend to your will.
Let's see. I mean, this is tomorrow night. This takes place, right? So it's going to happen pretty fast. So again, obviously the market's not pricing it in. Although I will say the VIX is elevated today on a pretty benign day, so maybe that's something to watch for sure. And obviously, gold continues to do its thing in a meaningful way, which we didn't talk about today because we talk about it every day. But gold continues to do the grind, as do some of these other metals. Silver's been catching a bit as well. So maybe some of the concern is manifesting itself in precious metals and in the VIX today, at least.
Well, and in nerd gold, you see the Bitcoin's up 3%.
And in nerd gold,
and
which that's your thing. Yeah.
That's my thing. It is not something that has actually been trading with gold. So it's interesting to see that today. All right. Well, Doug's highlighting of the banks is like, let's see how they act and what that means for the broader market. And I guess the other way to think about this, and we've been talking about the Russell 2000 and just the kind of catch-up trade. Look at the Russell on an intraday basis, Guy. I think this is kind of interesting. You and I did a trade in this, I want to say a week and a half ago, playing for a rejection. I think there was a large triple top that we kind of highlighted from a technical perspective. Let's pull up the Russell there. Let's pull up a 3-day. So you had that move lower. You saw a little bit of a back and fill or whatever, your gap fill. So this one down in the day is interesting to me, and the S&P has definitely lost some steam. One last name, Guy, and then I promise we'll get out of here. Let's pull up Oracle. And we don't have to go through the circular nature and the OpenAI trade and the, like the stock gapping up on that revenue, outlook or whatever that you and I are calling bullshit on, because they have to build out the infrastructure to get that revenue. But it is interesting. And you and I did a 300, 250, 200 put butterfly strategy. Really what we were playing for is a break of 300 to the downside and then a move back towards a gap fill in and around 250. When you start to see this sort of gap fill, maybe they can throw a 200-day moving average in there. In my opinion, I think investors are basically calling bullshit. They're basically saying this is maybe as good as it gets for a while. They're going to have to put up before they shut up on this one. You know what I mean? But, this thing was what percent? 200 to 350 between the 200-day moving average. Yeah. So talk to me. When you see the start of a gap fill, are you expecting this thing maybe to get back?
I am. I mean, that's the reason we outlined that trade. Yeah. We said there's an inevitability to this. We also said that at its peak a couple of weeks ago, whenever the hell it was, I mean, this was a company that was trading almost 40 times forward earnings, which is nothing we've ever really seen before in this name. And it didn't make a lot of sense trading twice a market multiple and, at least 2 or 3 standard deviation turns higher than where it's traded historically. So I don't know. Listen, I understand the headline. I understand what people got excited about, the revenue, but what Oracle didn't do, and we've talked about this, was tell you what earnings were going to be on the back of that revenue. And I think to a certain extent, maybe the market's at least taking a little bit of a breather here. I think 250 is inevitable, and we'll see what happens if and when. But this move actually makes a lot of sense to me.
Yeah, I'm with you on that one, man. These guys are raising debt. They're taking investments. They're doing all this stuff, to kind of build out this infrastructure. I mean, I think these are the ones, them and like the Lambda and the CoreWeave, they're the ones that get, left holding the bag. They're the ones who have to raise all the debt to build out the infrastructure. The hyperscalers are doing it basically with their cash flow that they're generating. And this is a company the first time since 1992 is going to have negative cash flow because of this build. I think the guide, or at least analysts, the way they're kind of modeling is that they won't go back to positive cash flow until 2029. Build out this infrastructure. And then on the flip side, they are so tied to OpenAI, which OpenAI is going to be losing money between now and 2029. So like there's a handful of things that could make this whole thing go pear-shaped. And then it's this kind of, OpenAI to Oracle to the neo clouds. It's going to circle back to Nvidia, you know what I mean? That sort of thing. So again, we'll save that for another podcast. Guy, you're sitting down with Liz Thomas of SoFi this afternoon for the Risk Reversal podcast. That's going to be in the feed. You and I are going to be back here tomorrow at 11 a.m., raring to go. And we're going to be doing a couple. We'll update those option trades that we talked about. Maybe we'll put a couple new ones on the legend there, Guy.
I think that's exactly right. It is a big week. Again, watch the VIX today because maybe it's telling a story. And that gold market, Dan, does not give up, man. It continues to do the grind.
Yes, sir. All right. Thanks, everyone, for being here. Thanks to Carter Braxton Worth of Worth Charting. We'll see you all tomorrow.